You know the dream, right? That feeling of finding that one stock, the next big thing, and just watching it take off. It's a great thought. But what if I told you that for pretty much everyone, and I mean everyone from you and me to the pros on Wall Street, that dream is, well, it's mostly a fantasy, and we've got the data to prove it.
So to kick things off, check out this quote from Alan Harris at the Berkshire Edge. He really doesn't pull any punches, does he? When it comes to picking stocks, he just says, people are awful at it. It's blunt, for sure, but it perfectly sets the stage for the challenge we're going to dig into.
So just how awful are we? I mean, really. Let's get into the hard numbers. Dalbar's annual report gives us this figure right here, negative 8.5%. And what that is, it's what they call the investor gap. It's the difference between what the S&P 500 did in 2024 and what the average equity fund investor actually got. And yeah, that's a negative number.
Okay, so to really see what that number means, take a look at this. On the right, you've got the S&P 500's return, and on the left, that's the average investor. See that gap? It's not just a small difference, it's a chasm. So what in the world is going on? Why is there this massive gap year after year?
Well, that's the key thing here. This isn't just about one bad year. This isn't some new trend or a blip on the radar. Nope. The data shows that the odds have always been stacked against us when we try to pick individual stocks.
And when you zoom out and look at the long-term picture, it gets even more, well, startling. There's this incredible research from Hendrik Bessembinder, who looked at almost a century of stock market data. And what he found was that more than half, 51.6% of all public stocks in history actually lost money for investors over their lifetime. Let that sink in for a second. More than half of all stocks were losing bets.
And it gets crazier. That same study found that a tiny, tiny fraction of companies, we're talking just 2.4% of all stocks globally, were responsible for, wait for it, 100% of all the net wealth created. Think about what that means. You're not just looking for a needle in a haystack. You're trying to find one specific, almost invisible needle in a mountain range made of haystacks.
So, if the data is this overwhelming, why do we all keep trying to find that one needle? Well, it turns out the biggest enemy isn't the market. It's the person staring back at us in the mirror, our own brains. And that brings us to the really fascinating world of behavioral biases, the little mental glitches that just sabotage our returns.
Okay, first up is a huge one, herding. This is that deep, almost primal instinct we all have to just follow the crowd. Instead of doing our own homework, it just feels safer to do what everyone else is doing. The problem is, sometimes everyone else is running full speed right off a cliff.
And this ancient bias has found a brand new, supercharged amplifier, social media. Get this, a staggering 61% of investors under 35 say they use recommendations from so-called finfluencers. The herd has officially gone digital, and believe me, it's moving faster and way more dangerously than ever before.
So this all creates what you could call the FOMO flywheel. It's a perfect psychological storm. It starts with herding. You see everyone else jumping into a hot stock. That triggers this intense fear of missing out, right? FOMO. You can't stand the idea of being left behind. And that feeling, that anxiety, is what drives you to make an impulsive and often totally irrational investment.
And herding is really just the tip of the iceberg. I mean, our brains are just littered with these little mental traps. You've got loss aversion, where the pain of losing $100 feels twice as bad as the joy of gaining $100. Or how about anchoring? That's when we get stuck on the first price we ever saw for a stock and we can't adjust our thinking even when everything about the company has changed. These are just a couple of the cognitive glitches that are constantly, quietly pushing us to make the wrong call.
Okay, so if our own brains are the problem, can technology be the solution? This is the big question, right? Can we use something like artificial intelligence to get past all these human flaws and finally crack the code of picking winning stocks? Well, the evidence so far is, let's just say, it's complicated. On the one hand, you see these really cool experiments, like a portfolio run by ChatGPT that gained almost 5%, while human-run funds were actually losing money. Pretty neat. But then you look at the bigger picture, at broader academic studies, and they find that these AI timing strategies usually end up underperforming simple passive investments. So for now, the jury is definitely still out.
All right, now let's throw a curveball in here. What if I told you that even a strategy that sounds totally smart, a strategy that everyone recommends, can actually be really dangerous? Let's talk about the hidden risk in diversification, especially when we're talking about small-cap stocks.
So to really get this risk, you need to understand something called impact cost. The easiest way to think about it is like a hidden tax on your trades.
When a huge mutual fund tries to buy or sell a massive amount of a smaller, less traded stock, its own actions move the price. That movement, that impact, can literally erase your potential profits before you even get a chance to see them.
And this is where the problem gets really, really big. Look at this chart. Since 2008, the total size of the small cap market has grown by about 25 times. That's a lot. But now look at the amount of money in small cap funds. That has grown by over 350 times. That isn't a stream of money, that's a tidal wave crashing into what's still a relatively small pond.
And all of this leads to a phenomenon that the legendary investor Peter Lynch brilliantly called diversification. See, with all that cash to invest, these giant funds are forced to buy hundreds and hundreds of stocks, including this long tail of lower quality, thinly traded companies just to put the money to work. The portfolio gets watered down, the quality drops, and a good idea, diversification, ends up hurting returns.
Okay, so let's put all the pieces together. We've got our own biased brains working against us. We have new technology like AI that isn't a silver bullet yet. And we have well-intentioned strategies that can completely backfire. When you look at it all, it really points toward a much, much simpler and, frankly, wiser path forward.
So what's the big takeaway from all of this? It's actually incredibly simple. Stop spending all your time and energy and stress searching for that one magic needle. The data from pretty much every angle suggests a far better strategy is to just buy the entire haystack.
And that really leaves us with one final, and I think pretty important, question to ask yourself about your own investing. When you pay a fee or a commission, are you really paying for investment skill and a sound strategy? Or are you just paying for hope and hype? The answer to that question could change absolutely everything for you.